We are going to talk a bit more about that at about 11:30, but let's talk a bit more about the markets here. Oppenheimer chief investment strategist John Stoltzfus joins us now. John, great to see you.
Terrific to be here, Wilfred.
What do you think happens if the One Big Beautiful Bill passes? Do we get a 1% jump in the markets, a fall by the rumor, sell the fact? What do you expect?
I tell you, I think the market likely will have a modest gain if it does happen. But I think the reason why it will be modest is there will be another group of both traders and investors who will be concerned by the increase likely in the deficit, and I think that, ultimately would be what would be of concern to the market. That said, at the end of the day, if when this thing finally gets fixed, because if there's any changes, it'll have to go back and forth in Congress before we really see what it looks like. Ultimately, I think the biggest worry for the market are the tariffs and where we wind up, how long it takes to establish what levels, where they're going to be. And in the meantime, the market feels that it is already discounted enough in the decline that we saw from February 19th through April 8th of this year, discounted enough the concerns around tariffs, geopolitical risk, and the budget.
Well, let's touch on that, because is it possible with markets where they are that President Trump decides to push the boundaries on the trade stuff next week again? Or either way, have we seen where the pain threshold is and the market kind of thinks if he does it and it doesn't work, he'll U-turn once again?
I think it's the latter. Indeed, I think the president is very sensitive in terms of to the market's response on the tariffs. He's very cognizant of what's going on with businesses' feelings about the tariffs, and I think that I don't think it's so much he chickens out. It's just that he responds to the reaction of the markets. I'm neither a defender of or an apologist for either the prior administration or this administration, but when you look at it, they all look at the market and they realize that more people are invested today than ever before. Investing by the private investor is more serious than ever because everybody realizes that while Social Security is likely to be around, there's a real need for private investors to invest today like institutions, and it's intermediate, longer term, better results if you stay in the market historically than if you try to time it.
I mean, part of your job in forecasting equities is looking at what the bond market is doing.
Yes.
And how that relates to valuations. 10-year yields at 4.30 around. Mm-hmm. So a lot of people think that this might be the low because we have all these deficit concerns and potentially higher tariffs and maybe some inflationary risks. Where do you see that going?
Sarah, I've been for the last 12 months have been saying I think the 10-year really trades in a range. It trades in a range to be priced to yield somewhere between 3.4 and 5%, depending upon where the data is coming.
That's a big range.
It's a huge range, exactly. And that's what people have said for the full 12 months too. But it's come to pass. That's what we have seen. I think what it reflects now, though, at these levels is more like normalization. The problem is, the free money era that we entered during the financial crisis it started 18 years ago at the end of 2007. So there's a whole generation that looks at a 4.23% on a 10-year yield and thinks that's a lot. I can remember, I've been in this business 42 years. I can remember showing fiduciaries of retirement plans in New York City 10-year zero coupon U.S. Treasuries that were priced to yield 13.4%, and they told me, because even I was young at one time, hey kid, forget about it. The Fed is going to fail. Inflation is going to skyrocket. We'll see yields much higher. That never happened, by the way. They were wrong. I was right. Lots of good it did me. But at the same time, what I'm trying to say is that I think we're really in a more normalizing era. Other things that we think of, it's not the end of globalization. Globalization continues, just diversified further away from one country, global supply chain centricity.
Right.
So we think things are actually getting better, even though there's always uncertainty.
Real quick, John, though, if we get a rate cut, maybe July, who knows, but does the market react positively to that, or do the concerns about a slowing economy overtake that?
I think the market has been looking for a rate cut sooner than later. I think if it comes in July and it's because we get some real negative surprise tomorrow, then we'll probably get a bit of a haircut. But otherwise, I think a modest gain might be called for. And I think what Sarah was saying earlier. I think Jerome Powell really is pretty well set on what he's going to do. He's watching the signal. He's not letting the noise bother him. And I think he's doing the right thing. There's a stickiness within inflation that still remains. We have not seen competition across the sectors return to the degree where you could really say that stickiness is going to be washed out.
John, great stuff. Thanks so much for joining us.